Everyone, how are you doing today? Awesome. Great. Well, I celebrated my 41st birthday last night, and I'm over-caffeinated right now, so we're going to be having a lot of fun today. All right. As you can see, I'm wearing my APT costume here. You can't go to any conventions in Atlanta because we've got Dragon Con and Anime Week in Atlanta without being in costume. I got my balaclava right here, and I'm a hacker. All right. Bad stereotypes. All right. Our presentation today is going to be entirely finance-based. We're not going to get into systems and other things. We're going to talk about companies that have been hacked, how it's affected their stock prices. Take a look at the top-line revenue and other things to see if customers really are leaving. I've dealt a lot with investors as well, so we're going to talk about how to deal with hostile investors on the board, and a little bit of treasury and cyber insurance. That's kind of a hot topic that's been coming up a lot today. So, it should be interesting. Then finally, if we have time, we'll get into a hypothetical exercise over defending your information assets using no IT, lawyers, accountants, and no technology. All right. So, disclaimer first. No facts are involved in here. These are all opinions, so don't try to sue me for slander or libel. All opinions are mine, none of my clients, employers, or anything like that. Unless you want to sponsor, I'll gladly take your money to say anything you want me to. All right. No offer to buy or sell securities. We're going to be talking about the stock market, so I'm not a licensed financial advisor, so you need to go and get personalized advice from someone who's a licensed financial advisor, accountant, attorney, or whatever it happens to be. Seek sane and qualified advice. I've had plenty of people tell me I'm insane. If you think I'm insane at the end of this, my attorney wants to talk to you. And if we have enough names, I can get away with anything. Awesome. Okay, so years ago I was working at Internet Security Systems back pre-IPO, which was really fun. Yeah, go ISS. But I took a turn out of technical InfoSec and got into compliance. Oh God, it's one of those compliance guys. Personal reasons. Compliance. From an InfoSec perspective, you think PCI and other garbage like that. But compliance is an interesting field. It typically reports to the board of directors, so even the CEO has to worry about us, which is cool. And we deal with a lot of things like anti-bribery, anti-corruption, child labor in your factories, environmental regulations, conflict minerals, stuff like that. It's a topic that's important to me, so that's why I made the switch. I'm a financial researcher, kind of a semi-pro. I'm also a certified treasury professional, something you probably don't see in the InfoSec world quite a bit. And then I'm also known as a cost cutter and an activist henchman. We'll be talking about activist investors and what they can do for your information security budget. My email address is up there. That also works on Skype or Link. And my Twitter handle is Dearest Leader. It's easy to remember because Kim Jong-il is dear leader, but he's only loved in North Korea. I'm loved and respected everywhere. So that makes me dearest. And that's just how I troll, bro. Kim, I'm laughing at the ridiculous haircut. All right, so fun stuff. I do a lot of volunteer animal rights and environmental work. I've been a nightclub promoter here in Atlanta, booking DJs and live acts since 1998. And used to be a model, and I appeared in several role-playing game supplements. That's actually me on the far left. So back when I had hair. A lot of cool side activities. The wardrobe also lets me get into stock photography too, so that's where I make a lot of my money these days. Gist of the talk is what we've been told is wrong. This is like the History Channel. But instead of looking at pre-Columbian Viking ruins and civilizations that we've dug up, we're going to be looking at numbers etched forever into the NASDAQ. There's a lot of bad information out there, and a lot of myths, such as North Korea hacking Sony. The only way that could have happened to get them off of the abacus and into something modern is if aliens helped them. So you heard it here before it airs on the History Channel. All right, so getting into the presentation. We hear stories that if you get hacked, you're going to have irreparable reputation damage, your customers are going to leave, the board's going to get fired, and you'll get hacked out of business. This is FUD that the vendors have been saying for a long time, and everyone wonders why this doesn't work on executives. Well, it turns out that that's not really correct. So we're going to turn your world upside down like this cat, cute cats. And what we found by drilling into the numbers is, companies really aren't getting hurt from this stuff. There's a lot of consumer apathy out there, and we're going to look at numbers to actually show that this is the case. So let's put on our thinking caps. Class is in session. We'll cut straight to the big boom, and what we have done here is hypothesized that hack companies are going to go out of business. So how would you do that in the market? Well, you would use back testing, which is putting on hypothetical trades at a previous date and testing to see how they turned out today. You hear theories like sell in May and go away. So you should be in the market for the first 5 months of the year and then get out until the next January. So you can look at cyclical things and see if this works or not. So what we're going to do, hypothetically speaking, is short sell 100 shares at the market on the close of the market on the day of the breach. So short selling, for those that aren't familiar with the market, you borrow 100 shares from your broker, you sell it at the current price, you hope the stock drops, you buy it back at a lower price, pocketing the difference, and then you give those shares back to your broker. And what we found here is, going back to 2011, is that very few companies have actually gotten hurt, and had you actually done this, which I don't recommend, is that you would be down $55,574, assuming that you shorted 100 shares of each one of these companies every time they ended up in the news. So looking at this says that you should be buying the dip, hypothetically, rather than shorting it. So, you're probably thinking, wait a minute, you lost how much money by doing this? We thought they were going out of business. This should be a surefire thing. Well, it turns out that things are different in the market. Please direct your attention to the video screens closest to you, because this is a little difficult to read. So what we did was we took a look at Target and XRT. XRT is the entire retail sector exchange traded fund. So it's a bucket of retail companies. And we're looking at the time frame around the breach. And we can see that, Target performed lower than the rest of the retail industry, but there's not a big divergence with a sharp vertical drop in the stock price. So this kind of says that things are flat. There's nothing really going on there. But let's take a look at Target after the breach. So this is from Black Friday into the preceding quarter. And you say, oh, well, look, they got hacked. Look at the stock prices. It's going down, and it hit an all-time low. Well, there's several things here when you dig into this chart that stand out. Number one is that the implied volatility statistic up in the upper left-hand corner, and this mouse is not going to work, is 25%. And what we have here is we have a gap on earnings day. So that says that Target beat expectations. You have a gap whenever the opening price is significantly higher than the previous day's close. So people were buying this thing like crazy, and it's just taken off since then. So that's not an indication of something that's really hurting. Implied volatility is the supply demand for derivative options. So this is insurance, put options in the market. So people were not buying insurance on their portfolios expecting things to go really south. Now, when we look at Walmart, oh my God, that looks exactly the same. Did I have the same chart? No, these are two different charts. Well, that's interesting. So, implied volatility is 23%. Walmart's a bigger company, so you would think that they would do better, not surprising there. But look at this, we have a gap down. So as far as Wall Street's concerned, even though Target got hacked, they're doing better than Walmart. So here you had the price open lower than the previous day. There's a small gap in between here. Now let's look at the whole market. Gosh, did I get my charts mixed up again? Because this looks like Target and Walmart. Let's go back. Yeah, they do look a lot alike, okay? So if we follow the hypothesis, the whole retail sector must have gotten hacked. And this here is very interesting. The implied volatility statistic is 52%. So that is twice the risk of the entire retail sector versus either Target or Walmart. Now, if we think back to Christmas shopping season 2013, we had the polar vortex going on. It was cold. People in the Northeast couldn't get out of their houses. So, okay, this is probably to be expected that things, went south during the shopping season. Now, if we look at Target today, and we got the breach all the way over here, they are up about 20 bucks from their low during the bad shopping season in 2013. And Market Watch says that their Black Friday sales are up 40%. Okay? This does not sound like a company whose customers are going to leave them, but they're not the only ones out there. Home Depot is in exactly the same situation. It's gone up quite a bit, high of $117. And the Wall Street press is all about on who cares about the Home Depot data breach. Now, if we get into technical analysis of Home Depot, we can draw a couple of trend lines here and see that it's in a bullish up channel. And we also have the 50-day simple moving average, this thin blue line here. And this is where traders will look and say, oh, well, if the stock's doing well, it's going to be above that line. And we can see here and here, the stock has touched that line. A lot of people have come in buying. Its next candle is green, and it goes up from there. So we're not really seeing that there's anything wrong with Home Depot. Okay, Anthem on the day of the breach. We've already got a bullish trend line in here, and we can clearly see that the stock bounced off of this. Didn't really go anywhere for the rest of the day. But the interesting thing is this purchase right here, somebody bought 59,894 shares in a single order and dropped roughly $8 million on this stock at one time. So again, would we expect this company to be going out of business if the professionals, this is obviously not an individual investor, but if the professionals are plowing this kind of money into Anthem? All right, and if we look at the correlation index here, it's highly correlated to the S&P 500. So on days that the S&P 500 is up, Anthem is typically up. It's just one of those staple stocks that tends to do well. Here we have a horizontal trend, so we have a double top. Stock went below that, bounced above it, and you notice it bounces off of it here and continues upwards. So we got a bullish channel. 50-day SMA is trending upward. We have a MACD, moving average convergence divergence, bullish crossover about to occur again. The relative strength indicator is starting to point up. And this thing's probably got some legs to run a little further. It didn't get below this horizontal support. So unless something really wild happens, it's going to continue up. Oh, and notice the 50-day SMA suddenly turned sharply upwards after they got breached. Strange. All right. This one's a little more difficult to read, so I don't like reading PowerPoints, but I'll read this one for you. This is a press release from Standard & Poor's the day after Staples got hacked, and it says, "We have seen many instances of payment-related data breaches at retailers we rate. In all of these situations so far, the costs companies incur because of these breaches end up being manageable and have not had a material impact on credit protection measures or consumer behavior." All right, so It's not me up here as the crazy guy saying, oh, this stuff doesn't matter. S&P is out there saying that, nobody cares about that. So, while you're thinking about, Santa Claus not being real and companies getting hacked out of business.
What, Santa's not real?
No, Krampus is, though. We have to think, all right, what's going on here? Well, first of all, the truth of the matter is data breaches aren't really hurting companies today, okay? It's just not happening no matter what we've been told. And the reason is quite clear, because Honey Badger don't care. In an Experian survey, 1/3 of customers, after receiving a breach notification letter, said they did nothing. Okay, they didn't proactively call the bank and say, cancel my card, anything like that. Well, that's not really too surprising because since a lot of people were foreclosed on a few years ago by the same banks that have the credit cards, I'm sure a lot of people were actually going to the stores that were breached and saying, oh, please steal this number. I want to get back at these guys. All right. But really, one reason consumers don't care, aside from the hypothetical breach fatigue that we keep hearing about, is the Fair Credit Billing Act limits unauthorized charges to $50. Now, most all of you have probably gotten a letter from your credit card companies that say, oh, we cover you down to $0. You owe nothing. Okay, so what's the incentive for being careful shopping online or caring if the number gets stolen from a retailer? Not your problem. It's the people that foreclosed on your house. It's their problem. All right? So, what does cause pain? Well, Batman is well known for causing pain, but not in this particular case. So again, we have to beat up on Aquaman too, just because. So if you blow up an oil rig, okay, that's really going to hurt your stock and your company's reputation. If you get a bunch of credit cards stolen or social security numbers stolen, that's not something that people are going to be seeing on the news every day. And they're not going to be feeling that at the grocery store whenever the price of shrimp doubles or you see Greenpeace on TV with all these oil-soaked birds. These real-world events are what really hurts companies' reputations. And from an InfoSec perspective, yeah, that is kind of sad because you have other things competing for people's attention, and this sort of bad news sells more news stories than data breaches do. Another one that came up in the past week was lumber liquidators. So 60 Minutes did a coverage on them, went to some of their factories and found out that they had levels of formaldehyde in their product that exceeded California EPA levels. So put this flooring in your house, and now you got all these toxic fumes coming out that exceed the appropriate levels. Stock drops by more than 50%. You can say that lumber liquidators got hammered. Ha-ha. All right. And Tilson Funds, who's been shorting them for many years, has continued to short them. And they've run out of shares to short. There are so many short positions out there that you can't find any stock to borrow to short this thing anymore. So this one may go to zero, but they didn't have a data breach. So you're probably still thinking, but the InfoSec press says that CEOs get fired, and we have to make fun of Donald Trump while we're at it too. You need to get rid of that tribble on his head. So at least I got the card cut going. All right. So the financial reality of what happened, with Target is that they had a pre-tax loss of almost $6 billion. Walmart ran into the same problem whenever they moved into Canada as well. American companies, when they move into a different country, they tend to underestimate the complexities, especially if you're in retail, supply chains and other things are just more expensive. So that's one of the things that in the Wall Street press, they talked a lot about this misguided adventure into Canada. A few stories mentioned like one or two lines about the data breach. But when we look at what gets people fired, do you lose $5.4 billion? Or, the data breach was $0.191 billion with a insurance coverage of $0.46 billion. So you had a pre-tax loss of $0.145 billion. against top-line revenue of $72.618 billion. In the finance world, we call this a rounding error. That is nothing significant, and as S&P said, that's not material. But when we do a fundamental analysis of what's going on, we look at the Q4 earnings call transcript. Earnings per share was $1.50. Okay, they were guiding 143 to 147, so they kicked it out of the park on earnings per share. Q4 sales were up 3.8%. Okay, so it should be negative if customers are leaving. Full year sales are 1.3% in store, and online sales are up 30%. And Target, as they used to call it, it's kind of lost its panache. A lot of people aren't really shopping there, compared to what it was 10 years ago. Big tell for me, though, is that they increased the dividend 19.8%, and they paid out $1.2 billion to stockholders. Yes?
But didn't a large number of the Target board members get kicked out, and they're less short-term than like the CEO is?
Yeah, I haven't kept up with what's going on with the board. It's quite possible that an activist investor moved in, to take control. Really finding the numbers more interesting, but we will get to board replacement in just a moment. You guys will find that interesting. So Home Depot, according to their earnings call, they carry $100 million in cyber insurance, and their gross breach expenses before insurance were $63 million, and after insurance, that's $33 million against $83,000 million in revenue. Gee, that looks like another rounding error. Okay, so earnings per share up 43.8% for the fiscal year 14, up 25.3%. So online business, they said that it's 36% versus last year, increase of 13%. So their online business has doubled there, and they're also increasing their dividend by 26%, so better than Target, and they're initiating an $18 billion share buyback program. So again, these guys are apparently doing everything right financially. Anthem is another one that was in the news lately. We have not had an earnings call since that breach, but they have $200 million in insurance. Okay, so they got twice as much insurance as everybody else does. It'll be interesting to see the financial impact, especially with all the buying that's going on in their stock. So, we have to ask, are we spending too much on security? The vendors in the back are going to start throwing things at me in a moment. But, when we look at what happened to Target and Home Depot, they didn't really get hurt. And, as an investor, my question to Target would be, well, you had these different teams miscommunicating to each other, ships crossed in the night, nothing happened. Better off just reclaiming those synergies and funneling that into a share buyback program and splitting some of it into a cyber insurance program. Just my opinion. All right, so with J.P. Morgan, Jamie Dimon's letter to the shareholders in 2013 says they have a security budget of $250 million with 1,000 employees. Now, the vendors are probably happy about that because you can sell a lot to J.P. Morgan. A lot of small companies would be happy to have $250 million in top-line revenue, let alone just having that for, a security department. Yeah, that's a nice Powerball jackpot there. And in Computer Weekly, after the breach, okay, they said that J.P. Morgan was going to double their security budget. So some lucky chief security officer somewhere is on his or her way to being a billion-dollar CISO. Now, how's that? It's almost as good as Apple being a trillion-dollar company. So we have to think about who else out there is looking at how much is being spent on security programs. And we get into the activist investors. These are some of my favorite people in the world. I've worked for companies with similar people. Top left, we got Jeff Smith of Starboard Value. Top right, Dan Loeb of Third Point LLC. Carl Icahn, bottom left, of Icahn Enterprises. And Bill Aikman of Pershing Square. So, what activist investors do is they will buy shares of a company, try to get control of the board, and most of these guys, some of them, not all of them, so I don't get sued, are your stereotypical corporate raiders. They go in, gut the company, and and then sell all their shares. Other activist investors out there are, kind of more compliance oriented. They want to get rid of child labor in the factories. They'll take reduced profits for better environmental policy or getting rid of child labor. So, activist investors, it's a whole ecosystem just like everything else. But these guys wield a lot of power, as you'll see. So Starboard Value, and that's Jeff Smith there, storming the gates of Olive Garden. His fund owned 8.8% of Darden, which is the parent company that owns Olive Garden and Red Lobster. And he published a 294 slide on why the company sucks. Just bluntly putting it. And some of the stuff was like dishwasher safe to go containers. Well, why would you spend extra money on that? And then other things that they were doing, they weren't putting salt in the water to cook the pasta because that would void the warranty on their cookware. So they were giving everyone crappy tasting food. So in addition to some financial stuff in the presentation, he said, look, they could just change the way they run the restaurant. So when activists call for replacement of board members, that's a campaign. So he went out and solicited the other investors and said, hey, I want to wipe out all 12 board members. Here's a presentation saying what we can do if we do it, and the shareholders approved. This guy didn't own 51% of the stock. He only owned 8.8%, and just by getting out there in an activist campaign, he was able to do it. Business Week had a story on a 28-year-old guy who started out with $50,000, and he would team up with guys like this and be the propaganda manager and go and talk to other shareholders. So, there's a lot of activism going on everywhere in the market. To also show how much this can hurt, and if you've ever run an InfoSec program and you see that relational investors bought into your company, you're going to have a lot of fun. So Timken is a machine shop. They make ball bearings and other gears and parts. So this company came in, bought up a lot of their shares, and by the time they were done, the pension was cut from 33% of cash flow down to near nothing. They cut the CapEx budgets by 50% across the board, and 50% of cash flow was then funneled into share buybacks to enrich the shareholders. So, if you're running an InfoSec program and you suddenly have to do it with half the money the next day, that's going to be a little painful. You're going to have to think of other alternatives. So why are we talking about activist investors? Well, after doing a little digging, I found Third Point LLC, and according to Activist Investing Review 2014, they have conducted 5 campaigns. They're apparently a really good company because the return Dan Loeb's getting for his investors is 73.4%. So, whenever you go in and start gutting companies and cutting costs, things really work out. Well, it turns out that Third Point was an investor in Sony. Now, if we look at what Relational did to Timken, we could probably say that there's some serious cost cutting going on at Sony as well. And Dan Loeb was seriously going after Sony Entertainment. Well, that was the subsidiary that we heard of that got hacked back in November, December timeframe. And what Third Point said was they were trying to get the CEO to spin out Sony Entertainment and either IPO it or break it off into a separate company with different management. They felt that Sony's management was not that great. So what Sony did was they compromised and said, we're just going to cut costs a lot. And that was enough to get Third Point out of the way. They said, well, we couldn't really take over the board. We couldn't force this spin out, so we're selling our stock, and we got out for 20%. Well, that was the quarter before Sony Entertainment got hacked. Now, you hear about how bad it was. They couldn't get access to their email, and they were faxing stuff to each other. Well, Third Point made out with 20%. Well, since Sony got hacked in November, December timeframe, stock's up 25%. Okay, so again, it may suck if you're there, but for the investors, this sort of thing works out really well. Next area that is something that a lot of InfoSec types don't really see that much of is debt covenants. You hear about your equity investors, but your debt investors are really the ones that you have to really worry about because they wield a lot of power over your company. You have restrictions on your loans that say that you have to have a certain debt-to-equity ratio or something like that. Now, in terms of debt covenants, if you violate the covenant, immediately it accelerates the maturity of the loan, thus the entire balance comes due at one time. Oops, so if you got a $2 or $3 billion loan, the entire balance comes due, they start hitting you with late fees, and then they start dinging your company's credit. And that's just one area. Radio Shack went bankrupt recently because they were not able to sell the company because they had a debt covenant in place, so they had to get the bank's permission to start closing stores and shutting them down. Other area is preservation of capital covenant. This is where the banks can require you to have a certain amount of insurance, and in a lot of cases, you're going to have cyber insurance, you're going to have building fire insurance, you name it. You can also have restrictions against dividends that you can pay and what sort of equipment you can buy. So if you think going to the CEO and saying, oh, I want to buy this firewall or this UTM device or what have you, and they say, no, we can't afford it, there's probably a banker somewhere in the background that said, unless you got a regulatory reason to spend money on this, we're not going to allow it. So a lot of your budgets may actually be going to the banks for their approval, not just to the CFO for his approval. So you may have your hands tied. And some of these penalties are immense. Debt covenants are there to enrich the bankers and not the shareholders. So Leucadia Capital loaned some money to FXCM. They're a currency brokerage. So again, no data breach, but a big financial impact. So in the brokerage world, if the customers don't have the money to cover losses, the brokerage has to pay. So they lost $300 million in one day. But Leucadia came along and said, hey, we'll loan you $300 million, 2-year term, 10% interest, and it goes up every quarter until it hits 17%. And then they can't sell equipment, buy equipment, or do anything without going to Leucadia Capital first. And then if they don't pay the loan off in 3 years, Leucadia can force a sale of the company. So this is where your debt investors have power over your equity investors. And I just absolutely love these loan terms here. So let's say they sell the company. Leucadia gets 100% of the money to pay off the loan. Next $350 million from the sale, they get half of it. Any money between $350 million and $680 million, they get to keep 90% of the money. And anything after that, they keep 60%. So, this is why I got into finance, because this is, where all the money is. And you may think that this is unfair, but, you did click I agree. So, all right. So, we'll talk about another area of the company that you may not deal with a lot in InfoSec, but it's very important. You need to get to know who is your head of Treasury. Treasury normally handles all of your company's insurance, your workman's comp, your business continuity, disaster insurance. They also handle your cyber insurance. And one of the interesting things when I first started going to financial conferences years ago was, you got treasurers and attorneys sitting up on a panel saying, we protect the company from data breaches. It's like, well, wait a minute, you don't have any IT equipment. How are you doing that? Well, they say that, to a financial department, impact to a company is shown on the balance sheet. Well, if your insurance is covering, the consultants to do the forensics, you can get insurance to cover lost revenue as an add-on. So at the end of the day, with the proper insurance coverage, it's like the Servco commercials. It's as if nothing ever happened. And, this is how a lot of executives, they're familiar with insurance. They're not familiar with, technology and things like that. A treasurer comes to them and says, yeah, we got some cyber risk, but I bought a $200 million insurance policy, and we are covered. So what does insurance do? Well, it substitutes a qualified promise for uncertainty. A lot of people think it's certain, but when you look at the contracts that insurance companies have out there, they're going to have a lot of exclusions. Now, unlike homeowners, renters, or automobile, cyber insurance and general business insurance is very customized. And it's not because they want to sell you the hole in the donut, not the rest of the donut. It's that every company has different needs. And they want you to talk to your broker about what you can do, and what your needs actually are. So we'll talk a bit about some of the pitfalls with insurance. Cyber typically falls under errors and omissions, also known as professional liability. So it's the same class as if someone slips and gets injured, or you have a medical malpractice suit. Some of the terms to be aware of is know the difference between first-party insurance and third-party insurance. So your first-party insurance is going to cover, what happens to your company. So if you have to bring in a consulting firm, forensics, PCI, stuff like that, that's covered under first-party insurance. If you're worried about the cost of breach notification letters, things like that, that's third-party. That is a third party that you have wronged in the course of your business. There's a lot of exclusions in your standard policy. So it says we don't cover terrorism or military conflict and things like that. So you need to take a look at the policy language, and this is why you need your Treasury Department and probably an insurance attorney looking over these things. Because think about if you have 5 or 6 insurance policies, a lot of companies will try to save money by getting something with a $20 million deductible but only covers up to 50. Then they'll get a different policy that has a $50 million deductible, covers up to 70. Because the risk to that second insurance company, because they have $50 million of front-end leeway before they have to pay anything, the premium is going to be a lot lower. So sometimes you're better off going to a single company, other times you're better stacking different insurances. Now, if there's a clause in there that says, oh yeah, our insurance company goes last, and you have a different insurance company that also says the same thing, you're going to end up in court, suing both of those insurance companies to figure out who is supposed to pay. Waste of time and energy. So do your homework up front. Insurance companies are going to pool you into buckets based on your industry. So if you're a retailer, you don't want to be getting insurance from an oil drilling company and vice versa. So talking to your insurance broker is something that everyone should do. And if you're not having the discussions with your treasury officer, about this stuff, about your assets, what information you have, how many customers' records could be breached, the Treasury Department really does need to know that. Common exclusions and gotchas. So insurance is there to replace equipment and other things. It will not replace any lost revenue. You can buy that as additional coverage, so it's just like a disability policy. So if you have your data center catch on fire or someone breaks in and deletes your entire database tables while you're restoring, you can have your revenue replaced. It's the same as a business continuity policy. Typically, these revenue replacement policies will cover your revenue from the previous quarter and pay that until you're back up and running. I've seen some debt covenants actually require companies to have 2 years worth of revenue coverage, because the banks want to get paid back. And if you've got 2 years to get back on your feet, the banks are more than likely going to get paid. The other gotcha here is if the insurance policy says it covers fines and penalties, fines are technically from the government. So PCI is not government. So you need a separate policy to cover that. Again, they're not trying to sell you the hole in the donut. They're trying to make sure that you don't get too much insurance. But there's so much out there that you probably need all of it. An E&O trigger is a wrongful act. So if someone slips and breaks their leg, you're going to be paying for that. Security and privacy policies, the trigger event is a security failure or a privacy event, and if you don't look at the fine print, more than likely it says it's a legislative-only event. So you see a lot of companies out there who will do a breach notification saying, well, we're not sure if the data was stolen or we don't believe the data was stolen. Insurance won't cover that unless you buy the extra coverage, because that's what's called a voluntary notification. And unless the law says that you have to do it, you really have to do that out of pocket unless you bought that extra insurance. So another reason why companies don't actually do the notification is they're probably sitting around with their attorneys saying, yeah, we technically haven't triggered the breach notification statute, so let's not preemptively send any emails or anything like that. You can add on a lot of things to your insurance policy. as well, such as punitive damages. Talk to your insurance attorneys about this one because some states, such as New York, will prohibit insurance from paying punitive damages, only compensatory damages. So certain jurisdictions, your insurance may not help you. So why pay for it unless you're actually going to get coverage? And then also, if you do have one of those jurisdictions, you may want to talk to your CFO about setting money aside for lawsuits and other things. We see that a lot of the Wall Street banks set aside money to cover lawsuits from the whole housing crash. We'll probably see companies setting aside money to pay damages for cyber incidents as well. You just reserve that off the balance sheet and hold on to it. Another interesting area of insurance that's going to be controversial to a lot of people in the room is cyber extortion insurance. So you get some lockerware that encrypts all your files, or someone breaks in, doxes you, and says, "Hey, we're going to put this stuff out here." Well, you can buy additional coverage to cover paying that off. Now, we hear that, you should never pay a ransom. In the insurance world, paying ransoms is kind of a common thing. Some of my previous clients from years ago had kidnap and ransom insurance for all of the executives. So, they're traveling in a foreign country, they get kidnapped, ransom gets posted. The insurance company will pay however many millions of dollars of coverage the company has. Different client had mercenary and rescue insurance. So they would actually cover the cost of hiring mercenaries to go stage a rescue if the ransom was turned down. So really, you got insurance out there to send guys in balaclavas and rifles in, but eventually we're going to get to the point where you got guys with these and laptops, trying to get your data back. All right, so in the few minutes we have left, we're going to do a hypothetical exercise. You guys will probably be horrified and amused by this one. So we're going to be consultants who are working for activist investors to secure data and protect the company's assets. So this is the scenario. You're a compliance consultant for an activist investment firm. A new campaign has replaced the board and C-suite. The target company will be transformed into an investment holdings company and operations will be spun out. Target company has recently completed an acquisition but has not completed a merger. Your mission is to protect the IP assets of the company while producing returns for the investors. So wait a minute, we can't spend money, we can only cut. And the chief information officer, the CISO, and the chief marketing officer were used to obtain synergies. Yes, Bill?
Fire the security team, get cyber insurance.
Yes, and buy the dip. Okay, so my dream team is these groups here. Whenever we go into a company, I'm going to leverage compliance and audit, both financial and IT. You're going to need legal involved in any sort of restructuring process, and of course you're going to need finance because you're going to be loading up on insurance. So what would you do with your audit and compliance group? Well, you need to find where all your assets are so you can buy insurance on them. The financial auditors will be able to find your physical assets. IT auditors will help you with your information assets. Compliance and legal is going to look at your contractual requirements. One thing that I always do to improve shareholder value is implement ISO 9001, 14001, 27001, whether it's manufacturing or a data center company. Because number one, you find out what your legal and contractual requirements are. Number two, it opens you up to government contracts, which causes you to actually spend less money on information security. I had a client about 2 years ago who won a government contract, and in the contract it said that the contractor agreed to be subject to State Freedom of Information Act for anything pursuant to that contract. So all of a sudden, the entire email farm is public. Okay, so now you don't have to spend a lot of money on DLP and other stuff to protect your email because the little town newspaper can just simply say, hey, government agency, send me all of your email and send us all of your contractors' email. Okay, well, yeah, we saved some money there. That's awesome. Legal. All right, so if you're not going to put a bunch of IPSs and encryption what you can do is you can patent your IP, patent, trademark, copyright, whatever. Okay, this is where we use lawyers to protect the information. To an activist investor, trade secrets are bad. They can get stolen. You got no repercussions except for the party that did the stealing. So once it's out, it's out. But if you patent it, you can go patent trolling people and sue them for millions of dollars. And typically, in an activist world, you're going to start licensing those IP patents to the competition, because it's doing you no good if it's just sitting there and you're not collecting royalties from it. Legal's also going to incorporate new subsidiaries, and they're going to be the ones overseeing some of the compliance activities, because compliance is just going to say yes or no. It appears to be compliant with the law. Legal's going to really take a look and say, okay, yeah, but even though it ticks the box, it does look kind of negligent or hokey. So we may or may not support that. So finance, you're going to insure your assets that the auditors have surfaced. And the other important department that's going to be involved in one of these exercises is your tax department, because trademarks, patents, and copyrights are taxed differently in different countries. So, if you have a global company, you may, and I apologize for this one, you may have reason to put some of this stuff offshore, which is why you need to talk to some licensed accountants. Subsidiary companies are very important. This is pulled from Tiffany and Company's 10K. And we're not going to do anything this complex where companies own companies who own companies for this exercise. But, in any type of company, you can really restructure like this. So the headquarters becomes the holding company. The important thing in this situation is to know that the holdings company doesn't produce any goods or services. So one of the subsidiaries is going to be the operating company. And we're going to have a real estate company, a staffing company, equipment leasing, and IP. You can stack your different business lines in separate legal entities as well. And the important thing about this is defense against contagion, all right? We're talking financial contagion, not computer viruses. But each legal entity is self-contained. So the customers have a contract with that one company. They can only sue that one company, provided your attorneys have set it up properly. They have separate accounting books and bank accounts. So the only money at risk is what's in that bank account for that one company. And what a lot of companies do, holding companies do, is they'll charge management fees down into the subsidiaries, and they will move that money out of those bank accounts. So by the time you file your lawsuit, there may not be any money in that anyway. Okay, this is how you protect a company against this sort of thing. Intellectual property, all right, trademark, patent, and copyright. If you notice, this Dunkin' Donuts cup, the logo is actually owned by DDIP Holder LLC. This is important because companies license, put the IP for the logos and other things into one company. Sometimes in a low tax jurisdiction, Amsterdam, has some great coffee houses. That's probably why Starbucks went there. Their non-tangible is taxed at 5%. So, if you look around online, The Guardian and other newspapers have said, hey, Starbucks charges, Netherlands charges Starbucks UK like £4 for the logo, so they're only making £1 of profit off of every cup of coffee. And if you're really looking out for the shareholders, your tax department's going to be doing this, and while you're working with legal to get this stuff under trademark, you really need to be talking to your tax department. You don't have one, I'm sure you can talk to one of the big four consulting companies out there, or a mid-tier company, to cover that. To bring other value to a company, what we typically do is fire all the employees and hire them by a staffing company. Yes, all right, Phil knows what I'm talking about. The value here is managers give people busy work, and if they're paying by the hour, that tends to go away. It makes the employees happy. Plus, we don't have to lay people off. We can actually open a new line of business contracting these employees out to other companies. So you're saving a lot there. Sale and lease of assets. Some people may consider this controversial. You sell buildings to get cash. You sell your source code, license it back. Why do you want cash? You can drive more debt for share buybacks. That's why you want to go in debt, so you can enrich the shareholders. And finally, the operating company has no real assets. There's nothing to sue for. It's easily replicable. So, you have a restaurant or something like that. Someone falls and breaks a leg. You just spin up a new corporation. It takes less than 5 minutes to do online. You transfer the business licenses and everything to that new corporation. You bankrupt the old one. Boom, you're done. All right, so America, mission accomplished. All right, America. All right, so at the end of the day, we got revenue per employee up. We've protected the IP by attorneys, so we don't have to spend a lot on IT, and we completed the financial renovations of the company. So at the end of the day, when you leave here, FUD doesn't sell well. People and creativity are your greatest asset. Okay, so don't be afraid of trying something different. Years ago, whenever I had an activist investor take over and I thought, oh my God, we're going to get hacked out of existence. Now, I've been at companies as a consultant where we've had no vulnerability patching going on. We laid all those people off and put them in the staffing company for other clients. And we've did not have any newsworthy data breaches during that time. So again, if you use bankers and attorneys, it's a different way. All right, we got question here, question here.
How many, have you done any analysis on critical infrastructure and breaching data?
No, I have not. I have not really looked at power companies, nuclear companies, and so forth. They're going to be a lot more tight-lipped, and because they're in a regulated environment, an activist investor is going to have to comply with the law, so they can't cut it and gut it to the extent that they would be able to in a non-regulated environment.
Even breaches so some companies are publicly traded companies. So if it gets breached and they have a huge blackout, and it's pretty much going to be their price.
It's definitely going to affect their prices in the short term. How much damage that's going to do in the long term. But again, they won't be able to cover it up as easy as other companies would be able to.
But their customers aren't going anywhere either.
That's true. It's a regulated monopoly. So and we can see with Target and others.
Yeah, then that changes the whole.
And Andy.
Yeah, just Phil's my boss. So
Okay.
if I get laid off on Monday, I'm going to call you.
Okay, that is awesome. Well, what he's going to do is he's going to stick you in the staffing company, and then you're going to be working in some call center. So there you go. All right, I think we're.
We have time for one more question.
Okay, in the very back with the baseball cap.
All right, so you have your intellectual property, so you're a manufacturing company. So China steals your data. What do you do then?
All right, well, had a client a few years ago that did this. Now, in China, one thing that the government will do when you first start doing business there, and you always want to do business with China, not because I'm wearing a Chinese flag pin on my suit or anything like that, but you always want to do business with China because, they're hypothetically could be bad actors. They could be bad actors in Russia too. Client I had a few years ago, what they did was they went to the Chinese government and said, you're going to license this IP for 10 years. Now, the standard IP agreement's typically 5. And what the Chinese will sometimes do is you start doing business there and they say, by the way, you owe us a business tax, but you can get out of paying the tax if you license your intellectual property to us. Well, now they have your blueprints and everything. So my client went uber aggressive with them and said, great, we'll license everything that you want, but you're going to pay us for 10 years, and you're going to have Delaware as the court venue, so you're not going to get out of it by breaking the contract. As Elon Musk said, if you're dependent on your patents for more than 5 years, you're doing it wrong. So, by forcing your business partners into a long-term licensing agreement, hypothetically, they could be paying for IP licenses after something has lived past its useful lifetime.
All right, thanks very much. Appreciate it.
Yeah. I'll be at the reception afterwards, so anyone wants to talk